Good afternoon, and thank you everyone for joining our webinar today. We are very excited about our latest offering in partnership with LSCRE. We are joined by Craig McGrouther from their team, as well as Chris and I here from 7P Capital. So we're excited to present Preserve at Copper Springs and excited to get into the deal and the opportunity. Quick disclaimer, this information is for informational purposes only and does not constitute financial, investment, or legal advice. Please speak with a qualified professional and your investment and attorney. So, quick intro from our team. Myself, most of you know, Bryan Morris from 7P Capital, one of the managing partners here at the firm, joined by Chris as well, one of our managing partners here at 7P Capital. And Craig, I'll let you introduce yourself, and Chris as well.
Absolutely. First and foremost, to all those who are listening here, we greatly value your time, attention, and hopefully commitment into this wonderful offering. And to Chris and Bryan and our friends at 7P, we're very grateful for this partnership. Just so everyone knows, this was not a fly-by-night, one email in and all of a sudden we're working together. We've had the pleasure of connecting now for almost about 2 years, I want to say. And I love it personally on my end when people work with you in a smaller extent and then graduate up to a larger extent, which is what we're going to be talking about today with this partnership. But we are very grateful for a deal together and also for a long-term and long-lasting partnership that will hopefully go through many decades together. We do business in decades, not in days or in years. So we take this very seriously. So we're very grateful. Starting with myself, I'm the Director of Business Development at LSCRE. I do a lot of things like this, which is webinars. I'm typically speaking the first person our investors and our partners probably meet and connect with. I do a lot of kind of stuff on events, capital raising, outreach, things of that nature. I kind of do it. So true business development on my end. And then taking you to the top left of the screen here, the founder and CEO, sole owner, Rob Beardsley, founded the firm in 2018. If you guys don't know who Rob is, he's kind of a savant. I was crazy enough to leave a very occupation, take a very large pay cut to start, but the vision is clear and I'm super grateful that I did it. And you don't meet many people like Rob in your life, but when you do, I have the pleasure of being best friends with him. But when you get to do business with him, it's probably the smartest thing you do to figure out a way to collaborate and work together. So I did that. He is truly one of one. To the right is his mother, Ina Beardsley, who's been in the real estate business for over 20 years. To the right of Ina is Sam Morris, who's also been in the real estate business and is a resident Houstonian, former corporate banker, partner to the firm, overseeing many key functions such as asset, property management, acquisitions, and some capital raising as well. You've got Dasha Beardsley, who works in tandem with myself and Sam on the investor relations side of things. Her goal, my goal, and Sam's goal, and obviously Chris and Bryan's, is to give everyone the best experience possible. And then to the right of Dasha, you've got Brad Oliver, who's our director of acquisitions, working with Sam and Rob to line up the best possible deals, and most importantly, to buy the best opportunity in the best location at the best price, which is what we're going to get into today.
Thank you, Craig. I'm Chris Ward. I'm one of the managing partners of 7P Capital as well. As Craig said, this is not just a few emails that have been exchanged back and forth. We have been building this relationship with LSCRE for 2 years now, including having invested personally ourselves into one of their deals to truly understand their operations, to understand their reporting capabilities. But we will touch on exactly why we love to partner with LSCRE in the presentation.
Excellent.
Awesome.
And then, yeah, who we are at a glance, as I mentioned, founded in 2018, almost a decade of real estate experience. Oftentimes people ask, hey, what's your track record like? What have you done to this point? Why can we believe you? Have you executed before? The answer is yes to all of those things, with 2 exits in the same market that we're talking about the property today, which is Houston, Texas. We've exited 2 deals there with the net average return blended between both of those offerings at a 25.1% AAR. I believe it's about a 32% IRR. Nevertheless, however you want to measure it, great success on those 2 deals. Our portfolio is now, after we acquire this one, going to be north of $850 million of assets under management, doing one thing and one thing only, which is buying multifamily units, multifamily real estate in Texas with 55+ hundred units under management. And what we do, I think that differentiates ourselves as well a little bit, is monthly distributions coupled with monthly reporting. So you're always going to know how the property is functioning, for the better or worse. If the worst comes up, you will always have a monthly report coming in. So although you don't have to worry about the tenants or anything like that, you'll know how the tenants are doing and what the performance is like on this asset should you get involved with us. And due to our strengths and our vertical integrations, we have 200 plus employees throughout the state of Texas, naturally. This is probably the stat we're most proud of. These two actually I'm gonna get into. All about portfolio count and units. That doesn't really matter anything for you. It just shows that we can do it. But the most important thing is that to this point, we have not made a capital call, meaning we haven't made additional investors bring in additional dollars into deals during this crazy market cycle and kind of resetting that we're in right now. And we haven't lost investor dollars nor been foreclosed, which is something that we're very proud of. And then so much so that we have over 400 repeat investors, which, any business needs new investors, repeat investors, and referrals. And we've got all those. We're very grateful for our partners like Chris and Bryan, who will be in that repeat investor bucket in this deal, and hopefully repeat partners on deals beyond this one.
Incredibly well said. Thank you, Craig. And as you guys can tell, there's a reason why we're deciding to partner with LSCRE and everything that they've done. We've been here based in New York for the last near 10 years, but really have been forming the relationship with both Craig, Rob, Dasha, and the whole team in their office. And they primarily focus on multifamily, which at our firm here at 7P Capital is our primary focus as of our growth so far. So why multifamily? I think there's a lot of reasons that speak for themselves here, right? Population growth that we're seeing in Texas post-COVID, the housing shortage nationwide, and just lack of affordability in housing and purchasing of housing versus where the rental market is. So there's a lot of demand for a quality asset, and you'll see in this asset, 2003 build in a very desirable area in Houston. Aside from that, obviously the benefits that come from a stabilized asset at close, Craig mentioned, which we love, is they do monthly distributions and reporting. So Chris and I can speak for that. In their deals, we see a very structured and detailed monthly report that comes out with financials and everything that you want to know about the property, which makes every investor feel at ease, right? To know what's happening at the property month in and month out, even if there's not much of an update for a given month, like you will get that update. So monthly cash flow, obviously the appreciation, the depreciation benefits that you'll get from a tax standpoint, and we'll get into that. Roughly 52% of your invested capital you'll see from a depreciation standpoint on this deal. But a lot of cases for why we love multifamily, especially right now in this market.
One of the things I would just share there is you can see on the bottom 1031 exchanges. If anybody is interested in doing a 1031 exchange, we can put you in direct contact with the LSCRE team to support that. Craig, can you remind us the minimums for a 1031 exchange?
Absolutely. And there's some nuance here, and I'm happy we're talking about that. So number one, let's say if you've got a rental property, perhaps you own some units yourself, you're that apartment manager or rental owner that is tired, wants to be more hands-off. Typically, the minimum is $1 million to work with us in that 1031 exchange capacity. There are at times where you make exceptions, but that's exactly why you reach out to Chris and Bryan, and we can kind of figure out a mutual thing there. But above and beyond that, too, the cool thing is, although you might be investing in this deal $100,000 or so, you at the end of this deal might have the option to roll to the next deal with us or cash out your investment as well, which is super exciting. Something that not every group offers, but it is a true way to make sense of the real estate investments and to really compound your wealth coupled together here, which is very exciting.
Speaking of 1031 exchanges, right? That is a slide that kind of just goes over what that would look like from a compounding effect. But where we're at with the U.S. multifamily market is those who have been following or have been investing in deals typical to this know that 2021 and 2022 post-COVID rates and money was almost free, right? Rates were 2.5%, 3%, right? Developers were developing at all-time rates, borrowing money, as well as assets trading at all-time highs, right? So peak pricing. So we really saw a peak in the market back into 21, 22, coming out of COVID, where everyone was doing deals and trading assets. Now, that has drastically cooled off over the last 3 years, right? So what we saw coming out of that was the drastic increase of interest rates going from the mid twos to mid sixes, which, as you would expect, drastically changes numbers that in underwriting, right? If you're underwriting to a 6.5% interest rate, you have a much different monthly payment than you would expect at a lower interest rate. So that had changed drastically. And so the deals weren't making as much sense, as well as developers were not getting permits to start builds as quickly over the last 3 years. So as you can see on the top, right, sales volume has plummeted over the last 3 years. And so we expect that trough to be somewhere near the bottom. You can never call the bottom. I wish we could. I wish we had this magic 8 ball so we know exactly when to invest every time. But we feel coming out of that, we are in a trough, and we have a very exciting time ahead over the next 5 to 7 years in this market, with the growth, population growth, and then the lack of supply that's coming on market, which you can see below. Deliveries were high, coming out of that 22 window, even through 2024, but they are drastically dropping off. So it's just a simple supply and demand, right, where there's going to be a lack of demand here in the coming years, which will help drive rental growth.
Yeah, and I'll also even add this too. Supply is not all evenly distributed. There's a lot of people saying, "Oh, Texas is overbuilt." Well, actually, it's more of a nuanced conversation. Sure, if you go to Austin, Texas, they've basically built 15% of supply in the area, and it will absorb over time. Even Dallas and San Antonio has got a lot of supply, but Houston, which we'll get into shortly, has actually a very large lack of supply. And even especially the property that we're looking to acquire here has a lack of supply in the immediate area, which just gets us very excited, and it helps really us be able to figure out and actually forecast future rent growth, which we're talking about here today, which is a large key to this investment acquisition.
So one of the reasons why we love working with LSCRE, beyond the fact that we have already previously invested with the organization, so we do understand the ins and outs of how they operate, is first and foremost their vertical integration. So as Craig mentioned at the start, they have over 200 employees located in Texas. What that means is within their operations, they have in-house property management, they have asset management, construction, maintenance. So essentially they are hands-on throughout the life of that investment. What that in turn means when we get into some of the details of the expenses that they're looking to trim the fat on, it's because they're able to manage that in-house themselves instead of outsourcing that work to third parties to operate that for them. Their sole focus is on multifamily acquisitions. They are not focused on development or any other asset classes, and they are focused exclusively in Texas. So what does that actually mean for you as an investor? That means they've been there, they've done this, they're in the market day in and day out. In fact, Rob, the co-founder, at one point did move down to Houston for a period of time to help stabilize one of their assets, which for us, when we look at that from a partnership perspective, it shows that they're aligned and they care about what their investors are receiving, but also the outcome of the business. From an underwriting perspective as well, they're very, very conservative with the underwriting. If you look into the deal room, you will have access to all of the underwriting materials, all of the details of what has gone into the underwriting, such as the expected tax costs. There's a dedicated webinar that we can also share with you, which highlights where Rob and Sam are ultimately detailing all of the ins and outs of the expenses that they are going to be saving there as well. And this last one, I think, is absolutely underrated, which is that white glove investor relations. So not only are they providing those monthly distributions, it's really those monthly updates. And I think we've touched on it slightly already a few times on this call, and we'll probably say it 2 or 3 more times on here. But the detail of those monthly and quarterly reports, they will give you absolutely everything you would need to have access to: the financials, the occupation, the trends, the previous 5 or 6 months, ultimately from when they've taken over the property. They give you access to absolutely everything. And that is also available now. So you can, in the deal room, see all of the different details, all of the underwriting, all of the pro forma that they've put together. So again, they truly do care about their investors. They are aligned with the outcomes of their investors, which is why Bryan and I are so excited to partner with LSCRE on this opportunity. K1 distribution is always targeted for the middle of March and distributed in time with that, which for you, again, a tax timetable is incredibly important. And believe it or not, we have all of their phone numbers, so we can get in contact with them at any point in time. We are texting in group chats all the time as well. So they are not, no person in that organization is too big to get a hold of. If anybody needs to be on a call, we can absolutely get them on a call and ultimately speaking with you or with us directly as well.
So here is our track record, and I think there's one thing to point out here is we've done several, obviously, refinances that have actually returned a meaningful amount of capital back, but you'll notice a theme once more. All Texas here, as you can see, and then obviously the predominant location is Houston, and that's exactly where this property sits today, and we're really excited to bring that up. You've got our 2 sold assets you can see, and if you also want to see a more comprehensive breakdown of those case studies and how fully went, please reach out to Chris and Bryan, and they can send over to you a link to our firm's deal room, data room, where you can access all that information. And then case studies, as I said, you can send that to you all. I just do want to double click here. Preserve at Copperleaf is just down the street from this property. It's our best performing asset, and we are very lucky to be talking about that deal today. As I said, it is once more, and we'll say it again and again, our most productive asset that we own, and that's why we're so grateful for this opportunity today, and why I think Chris and Bryan really jumped on it, because the execution of this one will be more seamless than probably any other properties that we will acquire, just due to our familiarity with the local vicinity, and actually a lot of the staff on property at Preserve used to work at Copper Springs, or Copperleaf used to work at Copper Springs, and vice versa. So we're actually bringing our best staff from Copperleaf over to Copper Springs. So that should even put everyone's risk tolerance even more at ease. And then here's just a general look at our investors' testimonials. Should you want a more comprehensive breakdown, reach out to anyone, reach out to Chris, and we can get you said people that you'd like to connect with to speak on us, on our character, and the experience that they've had above and beyond Chris and Bryan's.
And then quickly, from an investment summary standpoint, this deal we love for many reasons. And Craig, if you want to go into kind of the purchase price you're acquiring this asset at, the loan that you guys are getting this at, and then really the highlights of how this business plan gets put into place.
Yeah, absolutely. So we'll get right into that. So we are acquiring this property for $61,500,000, which is just around $163 per door, which we find to be instant equity, just considering the other recent sales comparables, which we'll get into later. Naturally, when you do a deal with us as well, the cool thing about us is we're very thorough, we're very comprehensive. So we do, a lease file audit. We walk into every single unit. We do very thorough and comprehensive due diligence. So when you see that CapEx budget with reserves, you'll note that everything that we're going to be doing will be accounted for. But we're acquiring, bringing out about $40 million of debt on this property, with projections obviously about a 1.95x equity multiple. But a little bit about this deal. They actually kind of are forced sellers because they acquired this property about 10 years ago and have a maturity coming here in April. Due to the fact that we've actually worked with the seller and broker, this will be the 4th time we've done it. The chair was pulled out for us, so they basically kind of give us the answers to the test. And we actually got this deal at about a $2.5 million discount from what the seller was looking to achieve via selling. I'm pretty confident if they actually refinanced this and held it for 5 years, they'd probably make another $30 or $40 million. But since they did buy it well ago, they're able to still exit this deal with capital. And I think it's just time for them to move on and not hold it for 15 years. But we are utterly delighted to get this property. And a bit about it, as I said, and I'll say it again and again, it's kind of the genesis of this deal, but it's down the street 1 mile away from our best performing asset, which is 97% occupied with essentially 0 bad debt or delinquencies, meaning on that 240 unit asset, there's basically no one not paying rent in there, and it's occupied at 97%, exceeding all of our projections initially, which is why we're so comfortable about this deal. And due to our geographical focus in this area, we'll be able to manage this property substantially better than probably any other group out there in the country could. Humbly, I say that, and also a lot cheaper than what Cortland, the current sellers, is doing it at. There's just a lot of fluff that they have in their systems. This is not cutting, meaningful people. We're actually going to be adding an employee on site, but we'll have 3 properties in a essentially 3.5-mile radius, and we're managing almost 900 units in that vicinity, and even larger in the area. We'll be getting up to almost 2,000 units in a 10-mile radius. So we're very comfortable, very confident. And then if you look at the key investment details, you're going to see that in-place rent and pro forma rent are basically the same. You might be thinking, well, how can you get these basically value-add returns but not really pumping up rents? That's because we don't necessarily need to. We've got other kind of revenue triggers that we're going to talk about on this deal to get there, but we're not having to reinvent the wheel or kind of do crazy things to get our projections. Oftentimes, you see in-place rents of, call it just for round numbers, $1,000, and pro forma rents are $1,400, right? Well, you kind of have to create a market there to get those returns. We're not needing to do that on this specific asset, and we're basically copy and pasting our exact expense model down the property. Although we all know that when you get more units, there's larger economies of scale. So we're basically using the same budget down the street on this property, which is how we're able to get meaningful and value-add returns with taking essentially little to no risk.
I love it. And one reason why we are so excited about this property is because they have that sister property literally a mile away, and the performance of that asset. We specifically asked for monthly reports, P&Ls. Like Chris and I did due diligence on that specific asset with Lone Star and LSCRE to make sure that that asset was performing top notch, which it is. So we're very excited to add this sister property to the portfolio. Houston, what's not to like about it, right? We've touched on a lot of the highlights, but #1 U.S. metro for projected rent growth over the next 5 years, right? #1 U.S. metro for projected population growth. As you can see, a lot of this post-COVID growth that came out of Houston was happening prior to COVID, but COVID just really put some gasoline on the fire there. And they're doing a lot of great things, right? A lot of Fortune 500 headquarters down in the Houston area, and we'll get into some of the investments that are coming with Apple and Nvidia as well, with some of this AI boom that's happening in the area as well. On that topic, major tech investment in Northwest Houston, where this property is located, right? So really just down the street, they are adding an Apple and Nvidia AI supercomputer factory. So really adding 3,000 high-paying new jobs, right? Robust employment and diversified employment that you're going to see in the Houston MSA market. And one thing we love is this Cy-Fair ISD school district, right? This school district is the #2 in the Houston MSA and #1 for athletics. So anyone who has kids or maybe has played athletics, understands the importance of a good school district and what families and parents feel about moving into an area like that, especially when it comes to athletics. Maybe I'm a little biased, but when you want to go to a school that is top notch, this is a great location and neighborhood to be living in for that specifically.
Well, it's actually part of the Texas culture as well, if you don't mind me interjecting. I mean, you've got football stadiums and high school stadiums there that look like college stadiums, right? I mean, these schools too. I mean, you go to certain areas, like I live in Arizona, just for instance, not very good schools. Texas, the best public schools, okay? Like we're talking about stuff that looks like nice college campuses is where these schools are. And this property sits in one of the best school districts, which is why we get so excited. And funny enough, Rob lived down the street from this property, walked to this property every single day saying he wanted to buy it. And then Sam Morris, our partner to the team who lives in Houston, his first house he bought was in this area for these schools. Okay. So we're not just saying this as kind of like a blank statement, because it sounds nice. We've lived it.
One other thing to highlight here in the Copperfield area would be no new supply within a 3-mile radius, which will continue to increase demand in a quality asset like this. Strong medium household income of $82,000. And what we kind of alluded to and mentioned before was the difference between renting and buying in this area. So you get a very high quality asset, amenities, and everything you'd want to see, including a strong school district that you can move into for a far less price than it might cost you buy right now in the market. Then location overview. Yep. I'll let Craig cover this because honestly, he's down and around that area all the time.
Yeah.
And so, yeah, go over this one,
The
please.
cool thing about this location is you can get anywhere very quickly. So you see the beltways. Houston's got 3 loops. This is just outside of the outer loop, not the outer loop. But from that system and from that area, you can really get anywhere in a very prompt manner of time. We actually had our corporate suite located there, which sometimes a lot of personnel on site needs to go to properties. So obviously we view expenses very seriously. So we have a unit that we currently owned we're renting for a while until that property had too much occupancy. We had to rent it, but we were there for a very long time. And I can speak to the ease to get anywhere throughout the city from this location. You cannot, sleep upon that by any means. And you can get kind of the major retail, you can get to any of the major job employers from that location. And then you see that Apple and Nvidia dot up there, very close proximity. No more than 15 minutes away. And, it's one thing to talk about future development. It's like, okay, well, this is developing and landing in 2030 or 2035. Great. What's in it for me? Like, I don't care. No, this is landing in 2026. That's going to deliver then. So that's just more new jobs coupled with a lack of supply in Houston, but particularly in the sub-market and radius that we're looking to acquire this property in. And we know the rents like the back of our hand. And, it's just, I can't speak to the level of knowledge we have for this area and the seamless integration to our portfolio and the ability to execute.
Yeah, it gets me fired up. And if you look at the Preserve at Copper Springs star there, just directly under that is where the high school is located. So it is within walking distance from the neighborhood. And so, again, excited about the location and everything that's surrounding it as a super strong neighborhood for people to want to move to.
So touring this asset and having knowledge of this one, and literally I've slept in the other property that's down the street, I can tell you that this property actually is frankly a notch better. The interiors are a skosh more updated. They've been done, kind of from the owner beforehand, as you can tell. Probably not the latest and greatest from the white look, but still very serviceable. But the cool thing about these units is the floor plans itself. Every unit's got a full-size washer and dryer, kitchen like as such, with nice finishes and whatnot. Really good high ceilings, great bones, and the square footage of this is pretty large. It's about 950 square feet. So you've got really nice, sizable square footage where people and parents can have their kids be here to enjoy the school district and stuff, creating kind of a stickier tenant base. And then, as you'd expect for any property built in 2003 in Texas, you've got really nice sprawling blueprint of the site itself, coupled with great amenities like covered parking. This would be the biggest fitness center that we have actually in our portfolio. It's an awesome gym. I can't say it's about an Equinox or a Lifetime, but it's, adjacent, I would say, for an apartment complex.
If I recall, I think I saw a video of you guys working out in the fitness center here.
I think your eyes did not fail you. That was certainly not AI. And if you want to share that with your investors, feel free to do so. That's, we were been there and turning through and making sure that all the equipment is working and RDD experience. The dumbbells are not fake. With that said, the swimming pool is awesome. You got the parcel lockers, everything you'd want in a property, this has. Excellent. Now, covering the business plan, would you want me to go over this, gentlemen?
Please. Yes.
Yeah, absolutely. So as mentioned, this is really a fat trimming exercise. There's a couple ways to create value, and the value creation that we like is more of the Doge route in a sense. So coming in here and kind of creating and knocking out expenses that aren't necessary. A dollar saved is a dollar earned and a dollar not burned, which is going back to your return structure, right, and return profile. So just going over on the left side, we're getting Freddie Mac agency debt. And one thing we love is conservative financing and leverage. At a glance, that was definitely mentioned in who we are and what we do. But because we're going at such low leverage, 65% loan to value, we're getting basically the best debt terms you can find on the market. And, even if you work with other, groups, other shops out there, their debt's probably not as accretive and as solid as this. And that's because of our relationships with the lender, Freddie Mac, but also when you raise as much equity and have lower leverage like this, you're able to achieve longer term of interest only. So this deal's got 5 years of interest only during it, which is really helpful in regard to creating meaningful cash flow along the way, but also getting incremental increases, because once that interest only period does burn off, you are paying down principal, but sometimes you have a bit of a cash flow drag. So we'll be able to get the best financing and really great debt terms along the way, enabling us to get, increases on the cash on cash return. And you'll see that as it incrementally goes up once we are fully stabilized. But we're able to get basically an 18% NOI bump through our vertical integrated systems. Essentially, this seller runs things very fat. We're doing things slightly differently. We're bringing a lot more stuff in-house because we do own so many properties there in the area. And one thing we're doing on this property is an ancillary income item. So what we're doing is we're achieving that down the street. So not making things up, not thinking if we can create a market. We're adding an ancillary income item about $120 a month, which is encompassing things that tenants are already going to be using and needing, such as bulk Wi-Fi that we essentially wholesale back to the tenants. Parcel lockers for your Amazon packaging. Everyone's kind of using that now these days, right? Also a gym fee, and then other kind of amenities that you get as well, like valet trash. So we're kind of rolling that up and adding that onto the income item, as opposed to hitting people with higher rents, other than organic rent growth that we're naturally going to get over the hold process here. But all units have been upgraded throughout. It's unanimous, so it's not like we're just showing you the good units and other stuff is not as nice. Everything is updated to a nice premium finish, which we're super grateful for. That was done in 2022. And as I said, the debt is really awesome in this deal. One thing I also want to note here, though, is the CapEx. So this property is very well maintained. Sellers don't own properties for 10 years if they haven't had a good experience there, right? Typically speaking, there's properties that you call hot potato properties, which is really junkier product, older vintage stuff, things like that. Well, this property is in a great location. It's a new build and has been basically immaculately maintained. But we are going to be replacing some of those roofs, the signage, some landscaping, and then just kind of an extra, contingencies for whatever may pop up above and beyond the reserves there. But a quick little anecdote about the roof story here. So we actually acquired property up the road from this one. This will be nestled between Preserve at Copperleaf, and then one of the more recent acquisitions in October of 25 of last year, roofs. So we got the cheapest roof quote there from our vertical integrated teams. We were going to do it for $250,000. The cheapest quote that we had, though, from a third-party vendor was $750,000. So that's $500,000 of your money, my money, that was going to be spent from a third-party person. So we really scrutinize everything here possible. And that's no different from this property. Actually, I think the cheapest quote would probably be about, 1.3 million or so. We're doing it for, $550,000. So that's just pure savings when you work with us, above and beyond the efficiencies that we get. And we're able to do that because we've got our contractor team basically for hourly, and then we do it for cost. So it is the most efficient way to go about it, is how we kind of do it. And, no guesswork on this property whatsoever. It's, truly a copy paste business plan here.
And I can speak from experience of having these kind of bulk amenities in an apartment unit and complex. It is so nice to be able to move into a property where you do not have to think about, how do I connect any of the internet? Where am I going to find a gym? Where is the swimming pool, right? Having all of that at your fingertips at a set price that you can budget for without going to have to shop around. Is it Verizon? Is it Optimum? Whoever that ultimately might be. Is a huge benefit for the end user, ultimately the tenants that will be living in these properties.
And then here's our footprint. Once more, we're going to say it again and again. We're reiterating points because they're very key and crucial ones. As I mentioned, Discovery at West Road was the property just right to this one. We did that roof. This property will be nestled right between Discovery at West Road, but closer to Preserve at Copperleaf. But naturally, the northwest pocket of Houston is our geographical stronghold. We love that area. There's no weather risk associated to it, really, per se, with flood zones or anything of that nature. So we love that location, and we wish we could buy more deals like this. Let's just put it that way. And then here's some comparables on the rent side of things. So you'll notice that we are not at the top of rents. Averages are slightly higher than where we are there. Obviously, there's a bit of a range, but the cool thing is that we do have some room to run there. We do think we can get that, but we're projecting to you more conservative numbers. We're very key on hitting on that and not over-promising and under-delivering. So we do think we will actually be able to beat a lot of those assumptions and projections, but we'd rather be conservative on this one, particularly when we take over the asset, we implement the amenity fee throughout. But you can see here, we are very confident with the rents, and we look at these every single day and have been for the last 2 years, because naturally when you do manage a property, it's not you acquire it and then you set it and forget it. You're actively looking at this to be competitive in the market. So we are very comfortable and confident with the rents here, and we'll be able to achieve those pretty nicely. And then, as I mentioned earlier as well, kind of going in this property with, frankly, instant equity to a certain extent. I mean, there's some trades here that happened in 23, which is by no means the market top there. But you can see that, properties are trading with a number with a 2 to start, right? So 5 years from now, we're very confident that the market will actually be higher than that. It's projected in there, but we are very confident with our per door price. And the two things in real estate you can't change is the purchase price and the location. Everything else is a temporary item, if you will, and knocking those two things out is great. And then coupling that with management, probably the most important component, will be a very, very smooth ride on this one, considering that our best team is just moving to this property.
I love it. Thank you, Craig, for going into detail. So how is our partnership structured, right? We, as we mentioned, work directly with LSCRE, and we work in tandem here to really extend this opportunity to both of our investor bases. And one thing you would see on our structure is we are offering this investment at a $50,000 minimum. So one thing to note is this is a 506C offering. So you do need to be an accredited investor. Once you get an accreditation, then you have access to this deal. And in our Class A, you will see that the minimum is $50,000 with an average annual return of 18.9% and a 1.95 times multiple. Class B, if you're choosing to invest $100,000 or more, you will get a slightly higher average annual return and a slightly higher equity multiple. From a waterfall structure, both are structured the exact same when it comes to receiving an 8% preferred return. So what that means is if you invest $100,000 into this deal, you are entitled to an 8% preferred return annually throughout the hold period. Now, if you do not achieve that, you will make that up in the back end through equity as it accrues. You will then get 100% return of your capital back. And once we have achieved your 8% return annually plus your 100% return of capital, you will then get a distribution split. So in Class A, 80% of profits will go to the investor, 20% will come back to the fund. In Class B, 85% of the profits will go to the investor and 15% will go back to the fund. So you'll see below an example of a Class A investment from $100,000, what that would look like. One thing to note would be a depreciation standpoint, 52% depreciation in year one. What that means is once we acquire the property, we will do a cost segregation study. That will pull forward the depreciation on this asset into different buckets. So as an investor, you will be able to take advantage of that. So if you invested $100,000 into this deal, you should expect to see roughly a $52,000 paper loss in your K1 in the beginning of 2027, which could be used to offset other passive income across this investment or across other passive income investments that you might have in your portfolio. May that be your own personal rental properties or other syndication deals that you may be in. So the timeline for closing, we launched this on Sunday. We've got an incredible response already this week. We wanted to get on with Craig this week to record. But as we mentioned, we are accessible and open to all investors moving forward. So please reach out immediately. We've had soft commits into our portal. We will provide a link on the last slide here that you can click and it will bring you straight to the deal room. We have a funding deadline of February 25th. Based on the response so far, we are getting soft commits filling up. So if you are interested, please reach out to either jump on a different call and we can talk one-on-one. More than happy to do so. We have a target closing of March 13th. So there is a pretty hard stop on this because of the loan maturity that the current seller has on April 1st. So we don't have much room to delay this closing. So we do want to ensure that you get your funds soft committed so you hold your spot in line. And then once we have the subscription docs, which we expect to have roughly in the first week of February, we can get those executed for you and then get you allocated to this deal. Once we close on the property, we will do the standard takeover process, and then you should expect to see a first monthly distribution there towards the end of May. And then just to wrap it up, to show Chris and I's faces, reach out to us if you would like to have any more information on this, there's all our contact information. So call us directly, please. Text me. We are both very open and open for communication at any point in time. I always just prefer a text message or a phone call. You don't feel free to book a call on Calendly or anything. Just reach out to me directly. We do pride ourselves in being available at any point in time. As I mentioned, click here to subscribe. That will bring you directly to our deal room, where you will see the deal room in our investor portal and all the economics in there. And that will house your investment as well as the subscription docs and hold your spot in line for your allocation as we come up to closing.
Just want to say thank you, Craig, for joining us and giving a detailed overview of the property, the business plan, and everything else that you've shared. We really do value your partnership. Thank you to everybody for taking the time to listen to this. As Bryan mentioned, we are getting a lot of interest in this, so don't wait until close to the funding deadline to start saving your spot in line. Reach out to us at any point in time, but thank you again, Craig. Thank you, Bryan, and thank you everyone for listening.
Thank you so much for your time today, gentlemen. And to all those who are interested or here listening, very grateful and appreciate your time, and looking forward to hopefully doing an incredible deal with everyone here.